Welcome to the Life Success and Legacy Podcast. We're glad you're here, and we hope you enjoy the episode.
Hey, everybody. Welcome back to the next episode of the Life Success Legacy Podcast. Thank you for joining us again. My name is Chris Bay, and I'm joined by Mike Crawford and Mike Everett. How are you, gentlemen?
Just wonderful.
Wonderful and doing well. For those of you who are not from the Midwest, we are living during allergy season, specifically ragweed season. And Crawford and I were just commiserating about our congestion and itchy eyes and all that stuff. Everett doesn't seem to have it, though.
I used to have it bad. I used to have to carry two hankies.
One in each hand. Hankies. Oh my gosh. Do either of you have dads or grandpas that carried the handkerchiefs? And we just reuse those things? That's too much. And then if you needed it, they loan it to you, but it's already been used. That's just gross.
I've got gross stories about hankies, but I don't think it's appropriate.
That's on next episode, Story Hour.
Story Hour with Mike Everett. Hey guys, let's dig into a topic that came up in our last boot camp. It was a really good question. It got into great detail. I don't know if we'll go specifically into that specific person's situation, but we will definitely cover a variety of things related to policy loans. So when we talk about infinite banking, and we talk about the four things that IBC does, we talk about eliminating outside debt, which means we're shifting outside debt like credit cards and car loans, etc., into inside debt, which is then reflected as a
policy
loan balance inside our policy. So there are policy loans taken there. So that's the first thing that IBC does, is we're shifting that wind current from outside debt to inside debt. Those payments then, instead of going to somebody else, never seeing them again, they now go to ourselves, principal and interest. Second thing is you then have your warehouse of wealth that you can use for anything you want.
That's right.
Expenses, vacations, whatever, investments, and that is a policy loan. And then passive income. You can use your policy as a line of credit, right? For investing in other things that create passive income. And in some cases, for people who have had policies for a long time, they're mature, et cetera, you can even get passive income from your policies.
That's right.
And then the fourth is the tax-free wealth transfer, which that is not a policy loan. So the first three of the four all are related to policy loans.
Right.
And as a recovering Dave Ramsey person, the idea of a loan and any associated interest just like triggers you, right? You've been so ingrained thinking that loans are bad. They are debt. So help our listeners, help us kind of wrap our head around, for people who struggle with, well, it's still debt, right? You're still dealing with debt. Help us kind of think through that policy loan issue as it comes up.
I think, I'm going to steal your stuff, Chris, really. I mean, we could be asking you this question for an answer, but when we have outside debt, what I call traditional consumer debt, credit card, student loans, car payments, whatever it is, those dollars that leave our hand go at a cost, right? There's an interest rate, most likely. They go at a cost out the door to those entities, and we never see those dollars again, right? Yep. And so when we take a loan from our policy, the policy is being used as collateral, as sort of like a home equity line of credit would be, the equity in your home you can borrow against. Similarly with the whole life policy, that's how they are structured. When we take that dollar, it does come at a cost, right? Because there is a dollar that has to be covered inside the insurance policy. So what do? They charge us an interest rate. But as Chris describes in one of his very good but long drawings, is that that dollar has to go, is going back to pay for things that benefit you and I, policyholders, which are the death benefit and the dividend. Both are valuable assets for our future, not only just existing within the policy as we're alive, but when we're gone, those go to pay that death benefit and guarantee the contract can stay solvent for the future. So when I look at a policy loan, I might be charged 4 to 6%, whatever the interest rate is from the company. It doesn't matter. And it could be higher, it could be lower. I don't care. My point is that unlike the 15% or 6% or 8% from my outside debt, I don't ever see that dollar. It doesn't benefit me. It benefits the stakeholders and shareholders of that company. And I'm the only shareholder of my policy, and it benefits me.
Yeah. You gonna say something, Mike
Everett? Well, I love that explanation. In fact, that drawing is actually one of my favorite drawings that we do.
Yep.
And one of the things that I think about, especially along the lines of a policy loan, I have been an entrepreneur since 1984. I have never seen a loan or a policy loan as a big deal.
Yeah.
Because I realize that
it's leverage.
That's right. It's leverage, and it's benefiting me and my family in some sort of way. But there's an extreme to it as well. So, and I'm sure somewhere along the way that we'll get to that. But policy loans are not a bad thing.
Mike, let's go back in time a little bit. Some of your longtime clients, maybe before we had boot camps and the Discord and all the education, we didn't have my very long drawings. We didn't have any of those things, right? Some of your longtime clients, not very many of them, just I'm thinking of one in particular, couple actually. They had policies for years, but they still had the mindset of if they took a loan against that policy, it was going to be debt.
Yeah.
So they actually had capitalized policies with no loan balances, and they were still utilizing the cash only mindset over here on the side. So it was like they were living a double life, right? Yeah. they're giving lip service to IBC over here. I've got an IBC policy, but over here in their other life, they're still doing Dave Ramsey.
Yeah.
What do you think plays in, or what do you think it is that keeps people from understanding or being stuck with that mindset of this policy loan is still debt?
Well, we talk about it. Actually, it's Nelson's fifth principle, which is rethink your thinking. So, as far as that kind of thought process is, we don't understand completely. In fact, in the early days, I wasn't able to teach this. And of course, we have learned over the years how to teach IBC at a very deep level. We call it getting in the weeds.
Yeah.
And so when you get somebody who just absolutely won't take that policy loan, they don't realize the benefit that it can possibly be for them by utilizing those dollars. It's the same dollars that they're going to use, but they're just not getting multiple uses of that dollar as it flows through their IBC system and out of their IBC system. So it's just a mindset.
Yeah.
Chris, can you go over for everyone the three uses? You do it very well. And I think following up what Everett just said, it would be helpful to have that reference.
Yeah, that's good.
Absolutely, because it was so important to me in my shifting of my mindset, and people who have listened to this know it took me a while, and I'm sure Everett was like banging his head against the wall, like, what is wrong with this kid?
You might still
But
be asking it.
he might still be asking that. Is that like a dark spot on your head, a bruise?
Yeah, here, hold on. I can find it. I can find it.
So what I love is, okay, from my background, Dave Ramsey, it was save up. And then we would take that money and we would go buy an old model, high mileage vehicle, right? And then we would start saving up for the next one. Well, I'm only getting one use of that dollar and I'm killing any compounding interest on that, right? And there's no death benefit attached to it as well.
Mm-hmm.
Whereas now I'm still saving up for that vehicle. I'm still doing the exact same thing. I'm just putting it in a more efficient placeholder.
Yep.
I'm saving that money up in the form of either premiums or policy loan repayments. I'm putting them into my policy where I get death benefit just as a byproduct. I'm getting guaranteed growth that is not tied to the stock market, so I don't have to worry about the roller coaster ride, right? It's just nice, steady going up. And when we need to replace a vehicle or whatever it is, we use vehicles oftentimes, I can then take a loan against my policy, still have the death benefit, still have the compounding growth, and use it to finance that car. And then I just start saving up for the next one with what would have been a car payment had I made that loan at the bank. I'm doing the same behaviors. I'm just putting it in a different location that is more efficient.
That's great. Chris, can I follow up on one thing you mentioned in there? I just want to use my home example one more time, because you said that when you borrow against the policy, you explained that I'm still gaining. That second use was that it is continually compounding interest. This is something I think a lot of people struggle with. They don't understand. And it took me, my wife and me both, some time to really grasp that when we borrow from our policy, we are not interrupting the growth of that policy, right?
And I would say, and I know we do this, but I try to hammer home the language borrow against our policy.
Yeah.
Just like borrowing against our home.
Correct. Yeah. Exactly. And that's the thing. It's like, I know a lot of people who have used home equity line of credits for a lot of different reasons, right? Home remodels, vacations, paying off other debt because the interest rate, was better, all of these things, right?
Yeah.
And there's nothing wrong with HELOCs. However, the thing I always reference, people know what those are more frequently. That's a more common tool to use for some form of financing. Is I always say, when you borrow against your home, right? Same language. When you borrow against your home's equity, does it stop gaining value over the time? Or does it continue to go up? Now, the market varies, right? It's not a guaranteed growth, but in many cases, over historical averages, the house value will continue to go up year over year. When you borrow against it, it doesn't adversely affect the growth of your home's value. It's the exact same principle. It's just in a life insurance policy that you are the sole owner of. It's the contract between you and that company. And I think that is the moment.
And that leads to another challenge. It's a mindset challenge that I think people have. And Mike Everett, you just were saying off air, you had a conversation with a client. Yeah. And it has to do with, we're so used to somebody else controlling the terms of the loan. And sometimes what this reminds me of is when you graduate from, say, high school or college or whatever, but you don't know what you're going to do next, and the world is your oyster. You could go anywhere, you could do anything. There's no limitations. You don't have any dependents, those kinds of things. It's almost overwhelming. It's too much freedom. What was that conversation like, or other conversations with clients who are, they don't know what to do with that control, that autonomy, that freedom when it comes to loans?
Well, this morning, as I was talking to this client, we were going over their strategy, and anybody who's listening to this knows that we provide step-by-step strategies over an 8-year period with our software, which is great. But yet you get some people that when they get their strategy some people will just say, forget it, I'll do my own thing. But then you'll get some people like this client that says, here's step 1, step 2, step 3, 4, 5, 6, 7, and I have got to stick to it regardless. So there is this tension, lack of freedom, we'll call it, that makes it feel just so cumbersome. It's just ridiculous. Well, when we spoke this morning, there was some thoughts that were happening. And when they shared this with me, I literally said, this is your money, your plan. You get to decide what sequence you want to pay these debts off. There was one down here that was going to be a car that, for emotional reasons only, it was about 4th or 5th on the pay down on the sequence.
Yeah. But
they wanted to put it at the top. And I said, great.
More power to you.
It's your money, your plan. And, there was you could almost feel the switch in their brain, and they go, you mean we can do that?
Yeah.
I said, this creates so much freedom and so much flexibility that, and then you should have seen it when I think it was a $480 payment every month. They said, you know what? I think that we'll begin to make that $480 payment back to our IBC system. And I go, you got it.
Bingo.
Yeah. It is so eye-opening and almost uncomfortable when you realize the freedom, the flexibility, the autonomy that you have when you control your own banking system. Now, that's why Nelson Nash has the principle, don't steal the peas, be an honest banker, because some people can't control that kind of freedom, right?
Right.
No.
All of a sudden I've graduated from college and I'm going to go backpack across Europe. And, I don't know what to do with this much freedom. I can't handle it.
Oh boy.
Yeah.
Well, I think that's one of the things as coaches, and we've talked about this in other podcasts, but I do want to highlight this. Like, when we as coaches have that moment with a client, like Everett had this morning, it is the reason. Not the reason. It is one of many reasons that we enjoy and love what we do.
Yeah. Yeah. I actually experienced that in about my 3rd year.
Yeah.
When the lights all came on, when Nelson and I had a moment.
Yep.
And when all of a sudden you start to see this, it's just like you cannot believe it.
Yep.
Because we have been, when we go borrow money from an institution, I don't care who it is, Visa, MasterCard, or your local bank, they get to decide the amount of money, the interest rate, and the time frame.
Yep.
So if you have a system, your system that you own and control, you get to decide the amount of money, the interest rate, and the time period.
Yeah. And Mike, when you're talking about the interest rate, you're not talking about the interest rate, the prepaid annual interest that the company is charging you. You're saying the interest rate for the loan, because the prepaid interest, we'll get into the prepaid interest here in a bit. I don't want to go down that road yet.
Okay.
One example this makes me think of is in my old education world, right? And if you have a novice teacher, they're thinking about teaching, Crawford, a little shout out to you on this. They're thinking about teaching from a technical mindset.
Yes.
Right? Yeah. They're like, I learned these rules from my textbooks, my professors, and in this situation, this is what I'm supposed to do.
Yep.
Contrast that with an experienced teacher. They will use technical skills, but they're also using adaptive skills. They've got all these tricks up their sleeve from all their years of teaching, and they're pulling those tricks out based on the situation and the nuance and the student and all those things. To make that connection to IBC, many of our clients in the very beginning, especially if they come from a technical mindset, which most financial stuff is, they're like, I got to do this way. I got to do it this way. It's got to be right.
Rigid.
Rigid. It's rigid.
That's right.
Yeah. And the reality of it is, as you learn how this system works, you can be more adaptive. And it goes from being very scientific or quantitative to being more of an art and qualitative, right? For example, do either of you calculate the interest when you take a policy loan that you're going to charge yourself?
No.
No.
No,
That's
we
a lot
don't.
of work.
It's a lot.
I like math. It's just too much.
We don't. But in the beginning, many of us wanted to do that just to build the system. What we do now, or at least I'll speak for myself, is I send as much as I can to my system in policy loan repayments. I don't really calculate what the interest is that I'm charging myself. Now, if it was a business loan, if you're a business owner and you're making a loan, a personal loan from your system to your business, and your business is paying you back, yes, we need to document that to keep all the CPAs happy. Okay.
Yeah.
But if it's just a personal loan that I'm making to myself to buy whatever, or to pay off a credit card or whatever it is, right? I don't calculate the interest.
I'm gonna use my client's conversation this morning. $480 payment. I said, well, if $480 works, would $500 work?
That sounds like EVA, Everett. Economic
value
value
added. I'm telling you what, it's one of the top 5 things that we talk about, but we don't talk about it enough in that context.
Right.
Yeah. When we say we're not calculating our interest and doing that, the reason is we understand economic value added.
That's right.
We're already charging ourselves for the use of our own money, because when I charge myself more and I'm sending it back to the system, that pool that I have access to is only growing.
It's just a bigger amount that you have access to borrow against your policy.
And oftentimes one policy is not enough to accommodate all of that EVA. So that's where we end up with multiple policies in a system of policies.
All right, I'm going to get back to basic teaching right now for everybody who's listening. The name of the book is Becoming Your Own Banker.
Yep.
So when the bank gets deposits, what do they do with them? They loan them out.
Yep.
Then all of the people that they loan those dollars to has to pay them back. But the minute they get it, do they let those monies sit? No. So what they're doing is they're turning the inventory. This is all, we talk about all of this in the webinar, and we touch on it during the boot camp. So the whole idea is your dollars are nothing more than inventory. And the more times you turn the inventory, the better off your system is.
And add just a smidge of economic value added.
Just a smidge. You don't even need a lot.
Well, and I'll tell you, the other thing we get asked this a lot was like, you know, how do you calculate that? People want to see spreadsheets. They want to know all that stuff, which is great. If that's where your brain goes, I respect that, because, you know, we have people with engineering type minds or very analytical minds with, you know, accountants, things like that. And that's great. That's okay. What I will tell you is that, you know, and I've said this before, is that my wife is not a technical person when it comes to math. But when she started, that was her brain. She needed to see the pennies and the dimes, right, going through the system. But once she hit that 3-year mark, and it was literally year 3, just like you were saying with your stuff, Everett, once she was like, she literally came to me and she goes, I get it. We just send as much as we can every month back to our system, and it gets better. I was like, yeah, 100%. She goes, why didn't you say it that way before? I said, I did. You just needed to hear Chris Bay say it that way.
I sometimes, I call it getting IBC saved.
Yes.
I have to do that with my engineers and my CPAs. I'm just telling you, the accountant types, it's almost a little work on my part, which really is good, because I'm a great big picture guy. Engineers and CPAs are not big picture people. And I meant that in the kindest way, by the way.
Yeah. We're grateful for those people.
Oh yeah, absolutely.
We don't want our bridges falling down, right?
Nope.
So let's dig a little bit into the cost of these policy loans. And this is for those people who really, who had that mindset of it's still debt. Okay. And as Mike Kwong says in his book, I'm going to do a little plug here, Dibs on Your Money. It has to do with the nature of the loan. Because not all loans and not all interest are the same. So when we make a deposit into our savings account, the bank, as Mike Everett just said, are they having those dollars just sit in the bank? No, they're loaning it out and getting a return. When we make a deposit into our life insurance policies with the life insurance company, is the life insurance company just having that money sit? No, they loan it out and get a return on it. Same activities going on, same behavior, right? And as policy owners with our name on my policies, my name is the very first name at the top of the contract, which means I own it and I have first rights to it, okay? And we only work with mutual companies, which is like a co-op, which means we want that life insurance company to make money.
Amen.
Yep.
Now, that activity and the bank activity is almost identical. One difference being fractional reserve banking that banks get to do, which if life insurance companies did that, they would go to jail. Okay. So same behaviors are happening. However, when I take a loan, which is actually withdrawal from the bank, is my money still growing as if I didn't touch it? No, it is not.
No.
When I take a loan from the life insurance company, my policy continues to grow. So let's unpack that just a little bit. Life insurance companies, and this is where the nature is different.
That's right.
Life insurance companies in a mutual company are investing our dollars for two primary reasons.
Yeah.
Number one is my someday death benefit. Who benefits from that? My family, my beneficiaries.
Yep.
They're investing our dollars for my someday death benefit, and I benefit from that. They are also investing dollars for annual dividends. And because it's a mutual company, I benefit from those dividends, not the stockholders. There are no stockholders in a mutual company. It's just the policy owners. So those investments benefit my death benefit and my annual dividends.
Yep.
However, if I take a loan against my policy from the life insurance company, that means that money that I borrowed, they cannot invest it. But in fact, they are investing it. They're just investing it with me.
Yep.
Now, if they were making on their investments 4 to 6%, don't I still want them to make 4 to 6% on the loans that they make to me?
Yeah.
So when I take a loan, they charge me a simple annual prepaid interest at the time I take that loan. I take that loan, they're going to withhold that, let's just say it's 4%. They're going to withhold that 4% to guarantee that they have made the earnings that they would have got had they been investing my dollars. They're just now investing it with me, and I'm paying that prepaid interest, which goes towards my someday death benefit and my annual dividend. It is a different animal. It is not the same kind of interest and the same kinds of loans that we are used to. And it makes a huge, huge difference.
We talk about these things over and over and over, and it seems simple to us. The mindset, and we talk about this all the time, the mindset that we have to have in order to make that work. But when all of a sudden the lights start to flicker and they realize that they're the owner, that they have autonomy, that they have freedom, that they have flexibility, and they can do with those dollars whatever they decide. It can be a car, it can be a vacation, it can be your kids' education, you can get a new washer dryer, you can send your kids to camp. I mean, fill in the blanks. But then I'm going to use a perfect example. Our family, we do a family vacation every year. It's usually a fairly large.
How many generations?
We have 3 generations.
Okay.
So my wife and I, the 2 kids, the 4 grandkids, we jump on a plane, we go somewhere and we go do something. Now, in the early days, it was a little cheaper deal, but now we got bigger numbers and it's not so cheap. I'm sure my kids and my wife are not going to listen to this, so I can.
No, they're not.
Yeah, I can.
But they'll still hear about it somehow.
Yeah, somehow. I'm going to talk about my sump pump here in a minute. So, sorry, folks, if you've listened to any of our podcasts, my sump pump's been a big deal. But back to the family. So what I do is I take my Visa card and I put 100% of those expenses on my Visa card. Now, do I get points when I use my Visa card? I get a bucket of points.
There's a use.
Ooh. And then what I do is when we get home and the Visa card comes running back to my mailbox, I look at this $10,000 to $15,000 expense that we just had. Let's call it 12 because it'll be easier math. I'll look at the 12 grand and I'll go, you know what? I should probably take a policy loan and pay that thing off. And then what I do for the next, second use?
Second use.
I pay that thing off and then I say, you know what? I'm going to commit a minimum of $1,000 a month for the next 12 months. And at the end of that 12-month period, have I fully paid back all of that 12 grand? By the way, did the Visa card get to charge me interest?
No.
They did not. But they charged me the 4% on the front end. But as I paid it back, they credited me back, prorated, that interest over that 12-month period. Now, if I've got $12,000 plus interest sitting back in my policy,
let's go on vacation.
Let's go. I'm telling you, right now we're starting to ponder a 70th birthday celebration. We were going to go to Scotland, but I realized I was going to have to like sell my grandchildren to go to Scotland. So we're not going to Scotland. I was thinking about, unbelievable golf courses. And when I got the estimate from the gal, this is kind of funny now. She goes, well, what's your budget? I said, oh, we're thinking like 20, 25. She goes, probably 2.5 of you will be able to go.
Wow.
I said something to Kurt. I said,
was it the air flights?
No, that was excluding the airfare.
Mm-hmm.
Oh gosh.
Yeah. And we decided we'd go to Charleston instead because there's a whole bunch of really cool little golf courses right there.
There you go.
Not that it's going to be about me, but it'll be my birthday. So
it is your birthday.
So it'll be about, me.
And that's totally different than normal. It's not usually about you.
Oh my gosh.
Okay, so you just gave an example of what you might take a policy loan for. And that is you go on vacation, you put it on your credit card, and then you take a loan to pay off the credit card. Then you turn around and you make loan repayments. Didn't calculate the interest, just said, I'm going to send myself $1,000 a month.
Yep.
Blah, blah. So for our listeners, go ahead.
I want to add to that. That is a fairly large example. So everybody has their level of how they want to take policy loans.
Yes.
And depending on who you're working with, early on, it was $500 for me. Mm-hmm. But then as life has kind of changed and we've gotten older and things have changed, I have changed my number and made it a bigger number. But yet keep in mind, as people are beginning the early days of their policy, $500 to $1,000 is not a bad way to start, because what you're doing is you're getting a rhythm.
Yep.
Mm-hmm.
You're taking a policy loan, then you're paying it back, and then you're taking a policy loan and paying it back. And that's what we're trying to create. We're trying to create a rhythm of how you would utilize your policy in the most effective way. Remember, your plan, your dollars.
And the biggest thing is shifting that mindset. So let's just, for fun, let's just brainstorm and talk about, both for ourselves and also clients, will be anonymous, of course, but what are the different types of reasons or items that people have taken policy loans for? And I will start by saying, Mike Everett, if I remember correctly, when I first was starting out with you with IBC as a client, I was still a school principal.
Yeah.
Our cash flow was tight. And I think you said somewhere in the range of, and I was like, well, how big of an amount should I take a policy loan for? And I think you said at the time, $1,500, $2,000.
Yep.
Something like that. Again, that number would change for me at this point in my life.
Yep.
It really depends. And so I think what people are asking is, when should I just use cash flow?
Right.
And when should I take a loan from my policy? Right. And that's going to be adaptive for whoever and their circumstances.
For everybody.
Yeah.
But early on, I mean, we might take a policy loan for a $1,500 purchase.
Yep.
Right.
Well, I mean, if you think about the software, right? Like when we're starting with a fresh, brand new family, I don't care who they are, and we're going through the strategy, our software has a little magic button called auto sequence on the debt. And it basically just organizes things from least to most. It's a pretty simple button, but it does the trick. And there are many times, I would say well over 80%, if I'm just guessing, that the first couple of debts are roughly $1,500 to $3,000.
Yeah.
Give or take. Now,
yeah,
there's a range. There's a lot of reasons that could be different. It may not fit your example if you're sitting here listening to it, but generally speaking, that's where we start, right? We have a moderately sized policy or two that we're starting with this new family. There's only about 60 to 70% cash value available those first years. Listen to our other podcast if you need explanation on that.
Yeah.
And we're teaching them just that rhythm. That is the thing that I when you said that word, Everett, I was just like, absolutely, rhythm is key.
So for us, some loans that we've taken as a business owner, we have taken every year for the past several years, we have taken loans to pay taxes.
Yeah.
So that, I mean, you think about what your tax amount might be, that can be a sizable amount that you
we do our home and auto insurance like that.
I do my home and auto insurance that way. Our biggest loan to date, I believe, was a down payment on a property. We took a sizable policy loan against our system and made a down payment on a property.
Same with us.
That was a big one. So same with you?
Yep.
Yeah.
But we paid off a few different cars with policy loans.
Yeah. Sometimes it's like Everett talked about, it's a credit card balance. Yep. We've accumulated a credit card balance for getting a kid set up at college in their apartment and putting everything on the credit card. That I get home, I do a policy loan and I pay off that credit card balance.
I just did a 0-turn Kubota mower.
Yeah,
that's personal right there.
Right.
Yeah, I love it.
We years ago, we had some medical needs for our family, and I had set aside money for taxes that year, but we had to use those dollars that I had set aside for taxes, 2017, not that I'm scarred by it at all. And we used that money instead to pay for those medical bills.
Yeah.
So we actually had a loan balance with the IRS.
Yeah.
And we carried that balance because it was a cheap loan, right? And Mike, this goes both with the mics. This goes back into sometimes there's math decisions and sometimes there's emotional decisions.
That's right.
It did not make sense to pay off that loan mathematically, but emotionally, I did not want to owe the IRS.
Come on.
So we took a policy loan and we paid off our taxes from 2017 finally and got that done. And it felt like freedom.
Oh yeah. That's how it was with my business loan that I had.
I remember that.
I remember that.
I sold the business, made some money off of it, but instead of paying off the loan with those dollars we used them in our IBC system. And this is no joke. It created so much more cash flow by doing that. Yeah. And so mathematically, it made more sense to do that. But emotionally, we were still like traumatized by that debt. So as soon as we could, obviously, we paid that debt off. And that was, we talk about like freedom dates sometimes, and boy, let me tell you, that was a freedom date for sure.
I will say also, we take policy loans for our investments, for our income snowball. Yeah. We use a policy as a line of credit for that. And we just flow that money. We take a loan, we do the investment, and then we make loan repayments back to the system. Mm-hmm. And we add a little economic value added to pay it down quicker. And then we do it again. That investment's paying me for 36 months, but I'm oftentimes paying off that policy loan in 4 months. Right. And I'm doing another one that's going to pay me for 36 months. So I'm just cycling it. That's velocity of money, right?
That's right.
We're keeping that money flowing as fast as we possibly can. Absolutely. Just keeping it going. Any other examples of policy loans? There's one more that comes to mind. We took a policy loan to start a new policy.
Oh, yeah.
We took a loan against one of our policies, our system of policies, and we started a new policy on Sean.
Yeah, we've done that because where does all of our money live?
That's right.
I mean,
so it's the creativity, the adaptability,
the flexibility,
all of the itities. It's just free. And it's fun and it's creative. And when you're in a community like our Life Success Legacy community, our IBC community, and whether it's us talking here within our podcast or within our Discord or at a live boot camp or even a Zoom boot camp, the ideas just start flowing and we learn from each other and it's really fun.
Yeah.
Any last thoughts on policy loans?
I like it.
Good stuff.
Most important thing to remember, don't steal the peas.
Come on now.
It is the secret ingredient to this whole family recipe.
That is principle number 3 for anybody who cares.
Do not steal the peas. Be an honest banker. Have a way, have a system for being an honest banker and paying yourself back. Don't cheat yourself. All right. To our listeners, thank you again for joining us. Hope today's episode was helpful for you, maybe sparked some creative ideas, maybe gave you a sense of freedom if you have been thinking about those policy loans as debt. But if you think like a banker, you want to have debt, right? You want to have that money out working for you and then receiving it back, plus economic value added. Check us out at our website, lifesuccesslegacy.com. Sign up for a webinar. Sign up for a boot camp.
We got one coming up Monday.
Probably not when this gets released, but
that's right.
Most Mondays, about every other Monday. Every other Monday. You can check that out on our website and register for one that works with your schedule. You'll get Mike Everett live in the flesh. He loves doing this every time. And check us out there. Check out some of our other things that we've got on there. We've got books, we've got some documents, all free learning. There's a learning kit. Check those things out if you like to kind of learn on your own. And then in the end, if you just want to talk to one of us, there's a contact us button and we will reach out to you and make that appointment. So thanks again for joining us. Check us out on our next episode of the Life Success Legacy podcast. Thanks, gentlemen. We'll see you next time.